Chapter 11. Financial Market. Question 2. Explain the following terms or concepts. 2 marks each. 1. Financial market. Answer. Financial market is a market where buying and selling of financial assets, that is financial instruments, take place. It serves as an intermediary between investors and borrowers by mobilizing savings and converting it into investments. Financial market facilitates productive use of the idle funds. It transfers the money or capital from those who have surplus money to those who are in need of investment for productive usage. Financial market offers the benefit of marketability and liquidity of financial assets of investors by providing them platform to sell their financial assets at the best possible price. 2. Capital market. Answer. Capital market is a market for borrowing and lending long-term financial securities and instruments. It is a market where financial assets having long or indefinite maturity period, like stocks, bonds, etc., are dealt with. Capital market puts surplus funds to productive use, and hence, it is a core of country's financial system. As per SEBI, capital market is a market for capital funds, comprising of both equity and debts. It includes private placement of equity and debts, as well as organized markets, like stock exchanges. Both individuals and institutions are participants in the capital market. The most important function of capital market is to provide ease of transaction for the both. 3. Money market. Answer. Money market is a market where lending and borrowing of funds take place for a short-term period, varying from 1 day to 1 year. It helps in fulfilling the short-term and very short-term requirements of funds of companies, banks, financial institutions, government agencies, etc. It is a market for financial instruments, which are considered as close substitutes for money, like commercial paper, Treasury Bills, etc. The financial instruments traded in money market can be easily converted into cash without any loss of time and value. 4. Call money market. Answer. Call money market is an important constituent of the money market in India. When the funds are lent or borrowed for a very short period, that is 1 day, it is called as call money. Call money market deals in short-term financial assets, which are close substitutes for money and are repayable on demand. Call money market mainly deals with day-to-day surplus funds of banks. Whenever a bank is facing shortage of funds for short period of time, it borrows money from the bank with surplus cash. Thus, call money market helps banks maintain equilibrium in their short-term liquidity positions. Therefore, call money market is also known as interbank call money market. 5. Treasury Bills. Answer. T-bills are the short-term securities issued by RBI on behalf of the central government to meet the short-term funds requirement of the government. T-bills have short-term maturities with highest up to 1 year. Currently, T-bills are issued with 3 different maturity periods, which are 91 days, 182 days, and 364 days. T-bills are negotiable instruments and are freely transferable. T-bills are issued for a minimum value of rupees 25,000 and thereafter in multiples of rupees 25,000. They are issued at a discount to the face value. At maturity, the investor gets the face value amount. The difference between the discounted value and face value is the return earned by the investor. Therefore, they are also called as zero coupon bonds. T-bills are purchased by individuals, banks, firms, institutions, etc. 6. Commercial bills. Answer. Bills of exchange are negotiable instruments, drawn by the seller, drawer, on the buyer, drawee, for the value of the goods, delivered to him. Such bills are called trade bills. Generally, trade bills have maturity period of 90 days, and are easily transferable. In case the seller wants immediate cash, he can discount the trade bills with commercial banks. When trade bills are accepted by commercial banks, they are called commercial bills. The bank can rediscount these bills any number of times till the maturity of the bill to meet the short-term liquidity requirements. 7. Repurchase agreement. Answer. Repurchase agreements are a formal agreement between two parties where one party, who needs money, sells a security to another with the promise of buying it back at a higher price at a later date from the buyer. Repo rate is the rate at which banks can borrow from RBI, and reverse repo rate is the rate at which RBI borrows from banks. This agreement is usually made between RBI and commercial banks. RBI uses this agreement to control the money supply in the economy. Of all the money market instruments, repurchase agreements are the most liquid, having maturity ranging from 24 hours to several months. 8. Primary market. Answer. Primary market is the market where companies sell their industrial securities, like shares, debentures, etc., for the first time, to raise fresh capital. As it exclusively deals with the issue of new securities, it is also known as new issues market. Primary market facilitates capital formation in the economy. It is through primary market that investors can invest their idle funds in a profitable manner, and companies can easily raise capital. Primary market can be further classified as equity market and debt market. Equity market deals with the securities, like equity shares, preference shares, rights issue, etc. Debt market deals with debt instruments, like debentures, bonds, fixed deposits, etc. 9. Secondary market. Answer. The secondary market is a type of market where the securities that are already listed on the exchange are bought and sold. Here, the previously issued securities, through IPO, are bought and sold by the investors. The trading on stock exchange falls under the secondary market. Therefore, secondary market is commonly known as the stock market or the stock exchange. In secondary market, the securities are traded between investors. Primary market is only for new securities, and secondary market is only for already existing securities.